Welcome, everybody. Thanks for joining today. Larissa will continue to let folks in, and we're also recording, and we'll share this with you after we do some editing of the video, so it'll probably come out next week. All right, so Justin and I are excited to be here with you. First, for those of you who are not familiar with VITALIZE, we are a seed stage fund and pre-seed stage angel network investing in the future of work. We define that as people first, data-driven, really big ideas that transform how work is done today. So our angel network is 350 people. We started that last year. We've done 10 deals, and then we're raising fund 2 right now. So we've made our first 6 investments. Our check sizes on the angel side range from 50 to 200K, and then our check size on the fund side is 250 to 750K. So I'm the managing partner at VITALIZE. I've been doing deals for 10 years. I've also done 45 personal angel deals and 6 small fund investments as well. And we are joined by Justin.
Thank you, Gale. I am Justin Gordon, Director of Marketing here at VITALIZE Venture Capital. I've done 8 deals so far. I lead all the marketing, so that means we have a newsletter called Revitalize. I'll drop a link in there for founders and friends. We have a podcast called the VITALIZE Podcast, which is really relevant to this group specifically because we have a lot of emerging managers, angel investors, other VCs on there. And it's another resource we have to help everyone with angel investing, as well as an angel community that helps launch and run with Larissa on our team, who's also here.
Awesome. Yeah, highly recommend the podcast. It's only 30 minutes, so really quick listen. And then the newsletter is also a fast read, so easy to digest content that Justin excels at. All right, let's jump right in. Okay, the tweet that started it all. So the story on where this webinar generated from is about a month ago, I was meeting with a CMO from Chicago of a high growth startup. And she said, I was at a talk and Amanda Lannert, who's a well-known CEO here in Chicago, was speaking. And Amanda asked out there, who makes over 200K? And a bunch of people raised their hand. And she said, which ones of you are angel investing? Hardly anybody raised their hand. And Amanda said, if you're making over 200K in salary, you really should think about angel investing some of that. And it was a really interesting conversation that I had with the CMO. She's like, thank you so much for sharing all of this. I had no idea tactically how to get started. And she suggested that I do this for other people. So I actually tweeted this that same day. And then we did our first presentation last week. And then this is the second one. So excited that you all are here with our main goal today, really being just to generate awareness of what angel investing is, as well as investing in small VC funds and bring more people to the table who are interested in getting started. All right, so let's start with some definitions. Private equity is multi-trillion dollars of an asset class. It's huge. It's basically anything that we invest in outside of the public markets. Venture capital is the earliest stage of private equity. This is institutional money invested in startups that have a lot of risk. So it's only $300 billion out of that massive private equity market. And then angel investing is the very earliest stage of private equity. This is the alternative asset class in which angels invest into really early startups. So an angel is just an individual investor. The term actually comes from the early 1900s in New York when they were Broadway shows and there were some struggling theater productions. These angels would swoop in with some financial backing and save the productions. And an angel group or syndicate is just a number of angels that pool their resources and capital to invest as one entity. So it can be a small number of people or several hundred angels, depending on which one you go to. In addition to those definitions, just wanted to show you the spectrum of early stage investors. So at first, we've got friends and family. You've heard of crowdfunding, angel group or syndicate that we just talked through, and VC. So today we'll really focus on angel group and VC as we go through the rest of the slides. But there's lots of ways to get started if you are interested in early stage investing in general. So once again, VC is about a $330 billion industry. And when I started doing deals back in 2012, it was just shy of 50 billion. So it has grown tremendously over the last 10 years. And then when we think about angel investing, it was about 1 billion in 2012, and today it's $4 billion. So also growing fairly rapidly over the last decade. And then let's take a step back and talk about accredited investors versus non-accredited investors. The SEC is a government regulatory body that defines an accredited investor as somebody who has made over 200K of net income in the last 2 years, or along with their partner, 300K of income in the last 2 years. That qualifies you as an accredited investor in the US, or you can have $1 million of net worth outside of your primary residence. So today, about 11% of the households in the US are accredited. The last data that I found on number of active angels per year is a few years old, so I assume it's higher than 300K. But at that time, only about 2% of the accredited population was actually investing. I assume today it's still south of 10%. So not a lot of the accredited investors are investing in the angel asset class today. Another data point that I could find on diversity of angels is only 22% of angels are women, and there's not data available widely on other underrepresented groups. And that's something that's really important to us at VITALIZE. I mentioned that we've got VITALIZE Angels and it has 350 people. Over 70% of our check writers have a diverse background. And then finally, we'll talk about this a little bit later, but VITALIZE Angels also allows non-accredited people to participate. So we know that some of those folks in the US can deploy a piece of their capital into crowdfunding. So that's 90% of households that fall into that bucket. So why should we angel invest, or why might we want to angel invest? The first is to diversify our existing portfolio. The next is potential tax savings. So there's something called qualified small business stock that we won't get into in detail, but it's really important to know because if a company that you invest in qualifies and you hold that stock for 5 years plus, you don't pay any taxes on the gains. So it can be a huge win for early investors that are investing at the angel stage and then end up seeing a great exit after the 5 years. A lot of angels want to do angel investing to stay abreast of trends and learnings that are relevant to their industry at work. They also like to help founders. Angels are some of the coolest people that I've ever met. They love to roll up their sleeves and provide assistance to those really early founders. Some people want to get into VC at a later point in time. Angel investing can be a great way to build a portfolio and get experience prior to the time that you're ready to start that VC role. And then finally, to have fun. If you've ever been at a cocktail party and you've heard people talk about their investments that they make, it can be a really cool way to have some topics of conversation to bring forward. All right, and now the main event. How do we get started as an angel investor? So we're going to go through each of these in detail on the next slides. But first, you want to calculate how much money you want to deploy each year as an angel or into VC funds. And this is typically somewhere between 10 to 50% of your investable cash. Next, you want to decide if you want to be active and do direct investing into a number of different deals or invest in a fund so that VC manages the diversification for you or some combination of the two. Next, you want to decide what's important to you, what themes do you like, areas of focus, industries, or if you're going to go the fund route, which general partners do you resonate with? Next, it's just learning, reading books, articles, blogs, social media posts to learn about this asset class and continue to refine what your strategy is. It's joining a couple of angel groups or syndicates to start seeing deal flows, to sit in the room, to hear pitches, and to hear how others are thinking about their investing strategies. Just makes us smarter when we're in those situations. And then lastly, start as early as possible, though commit to a long-term strategy. And it's really important to start as early as possible because it takes time. It can take 10 to 12 years to get returns from this asset class. And by starting earlier, we have time to redeploy that capital again and again before we retire. Quick note on portfolio theory. So it's just defined as optimizing expected risk-adjusted returns within your portfolio. It dates back to the 50s, and it's all about diversifying. So you don't want to put all of your money into just one deal. If you pick well, great, that was awesome. But most of us need a bunch of bets because only a few of them are going to have the potential to be big returners. So for an angel or VC, we typically see portfolios of 15 at a minimum, sometimes over 100 investments. And those investments are compiled over a period of 3 to 5 years. So most individuals that decide to invest in this asset class will pick somewhere between 1 and 3 funds, or at least 15 individual deals to have the portfolio style returns potential. All right, let's go through an example. So determining how much you want to invest. Let's say you make 150K a year. After your taxes and expenses of 100K, you're left with $50,000. This is your investable cash. You can do whatever you want with this money. You decide, okay, I've already got quite a bit in the public markets. I don't really want to get into real estate or anything else. So I'm going to put 50% of my investable cash into angel deals and VC funds. So this will be 25,000. So whatever your math looks like, you're really trying to get this end dollar amount that you feel comfortable lighting on fire. You don't want to do any angel investing with money that you need in your 3 to 6 month cash saving buffer. You don't want to do any investing with money that you need for living expenses. This is money that you don't necessarily need to survive. It's very important. All right, so now you know you want to invest 25K. So are you going to do directs, which is deal by deal investing, picking and choosing? You want to aim for 25 over a period of about 5 years. Most angels do somewhere between 3 and 10. So in our examples, we're going to use 5. All right, so let's say you've got 5,000 to deploy. A fund, you don't really have enough with 5,000. So you would be doing direct deals, and you'd need to find a way to do about 5 deals a year, $1,000 each. You've got 10,000 to deploy. Most funds are going to be too big. And the reason that funds can't take really small checks is because there are limits that the SEC has in terms of number of investors that can put money into that vehicle. We are at VITALIZE creating, I think it's going to be a 4 GP vehicle. So it'll be VITALIZE and 3 other second-time funds. I will know more next week and be able to announce what that looks like. But the goal is to allow 249 investors to invest 10K a year, so a total of 40,000, and you'll be buying the same percentage of each of those 4 funds. So you'll get diversification, not just across 4 managers, but 4 managers' portfolios to kind of get a really big pile of companies through this vehicle. Or you might want to do directs, and if you've got 10,000, that'll be 5 deals a year at 2K each. We go back to our last example, the 25K. You could invest in a, say, $10 million fund. There's a number of these out there. I've actually done 6 of them. They're all 25K checks into funds that are about $10 million. Something to note on a lot of funds, that capital will be called over a number of years. For a small commitment like 25K, you're likely going to need to give it all at once. So you might decide, I'm going to do 3 $10 million funds, 1 per year. So my first year I pick one, I do 25K. My next year I pick another, I do another 25K. And then I do my third one in year 3, another 25K. That's a great strategy. If you want to do directs with your 25K, you can do 5 deals at 5K each. Let's say a 50K. In this one, you might say, all right, I want to do a $15 million fund and I want to commit 150,000 because I really know this GP. It's a health tech GP. They have really great performance in their funds, and I know this space. I think that it's a really good opportunity. So you commit 150,000, and that means they're going to call it over 3 years. Each year for that same commitment, you're giving $50,000 to that GP. So it'd be 1 fund in your 3 years, but it's a way to get more concentration into a fund if you really believe in it. Or with your 50K, you could do 5 individual deals, 10K each. So there's lots of variations here, but we wanted to show you some examples of how to go from your number that you calculated based on your income and expenses to some different strategies that you could deploy to generate that portfolio style returns potential. All right, so now you know about how you're going to deploy the capital, whether it's funds or directs, and what your dollar size per each one's going to be. So what do you care about? A lot of people invest in specific industries. So it might be healthcare, fintech, future of work, consumer, either products or tech, crypto, Web3, SaaS, and the list goes on. So for me personally, we invest in future of work out of VITALIZE. I have done a lot of angel investments in that space. So of my 45, I bet I have 10 to 15 in future of work. But I also do a lot of consumer products, consumer tech. I've done some Web3 stuff. So it's for me, it's really what I think is extremely interesting. And then I also look at a few other things. So in this next bucket, for me, underrepresented founders are important, and as well as stage. I like really early stuff. So that's how I've kind of developed my my hypothesis personally. But you might care about geography. So maybe you're located in Boston and you really want to give back to the Boston community and invest in those founders. That's great. Maybe you're looking for a specific return profile. You like stuff that has lower risk, but you think it's pretty high likelihood it gets a 3 to 5x, versus another angel might say, I want to do stuff that has 100x potential, and a bunch of them are going to go to 0, but I'm really swinging for the fences. So we're going to get lots of ways to think about this, but it's really what is authentic and important to you. If you decide to go the route of funds, which GPs do you like? Who do you believe in? Who's raising a fund size that could be a fit for your approach? and where can you get allocation and a match for the amount that you want to put in per year for their fund. And then last couple of steps, it's learning, it's joining those groups. And then the most important thing is to start now. So take a step back and tell you about my first experience angel investing was in 2016. I had a friend of mine come to me. She's a Chicago founder, and she said, "We put $5,000 into my startup." And I had honestly never thought about angel investing, even though I was running an angel investment network at the time. I just didn't think I had enough money. But when she asked me, I was like, "Okay, I know you well. I think you're a great founder. I'll give you the 5,000." And that company didn't make it, but I learned from writing that check for 5K that I wanted to do more of it. So in 2017, I did some more. In 2018, I did some more. And over the last 5 years, I've slowly built to my 45 company portfolio that I have today. And as I sit here and look at where it's sitting on my books, it's about a 2.5x. When you look at all of the deals, even the ones that came in recently that are still sitting at a 1x. I know that I have the potential to get a couple of returns by year 10. And the goal for me personally is whatever returns I get, I'm going to redeploy that and redeploy that again. And I'm really glad that I was asked back in 2016 to write my first check, because I see now the importance of time in this equation. So another point on portfolio theory, it's the power law of startup investing. So 80% of your returns are going to come from 20% of your deals. So if we go back to our example and you do 25 companies over 5 years, we think about 5 should drive the majority of your returns. So it underscores the importance of getting that diversification once again, because your returns are going to come from such a small number of your deals. So for most angel investors, they're looking for a 3 to 5x return over a period of 10 to 12 years. And when you calculate the net IRRs from that, it tends to be 20 to 40% versus historically the stock market averages 10 to 12% per year. Varies very much year to year. Sometimes it's negative, sometimes it's way higher than 10 to 12, but the historic average is 10 to 12. Whereas in angel investing, if you get portfolio style returns of 3 to 5x, it'll look like a 20 to 40x net IRR. All right, so next steps, write the first check once you figure out your steps and what's important to you and how much you're going to invest. And then you write your second check, and then you keep pace to hit your first 5 deals or however many deals you're trying to do in year 1, and pay attention to what you learn. You'll start to hear feedback. You'll get reports from the company. You'll pay attention to different things in the market as you start to deploy into this asset class, and you can constantly adjust your strategy as you learn things. And then just keep it up year after year as long as it continues to make sense for you. Once again, only invest what you can truly afford to lose. So let's walk through a couple of examples from VITALIZE Angels. One is Lunch. So Lunch is a deal that we did recently. It's a payment infrastructure for the offline economy, starting with school vendors. So right now, if you're a school vendor, you're not getting paid for a long time. Lunch has a debt facility and a software platform that helps those vendors get paid almost immediately. So they're actually doing fairly well and maybe raising more capital soon. When we invested, had early revenues, had a VC participating, strong founders, big vision, and our math of VITALIZE Angels that we're looking for is at least a 30x plus return potential. Another example that hits the work revolution is an on-demand platform for hiring cybersecurity experts. It's accessible to all businesses, so that's Cyber Pop-Up. Once again, we love the founder, early revenues, another VC was participating, big vision and high return potential. We've done about 10 deals through VITALIZE Angels, and this tends to be the type of deal that we're doing, with the goal being that a number of them have the ability to return quite a bit. So I'm always asked, how do you track all these investments? So I want to share with you what my Google Sheet looks like. It's just a basic Google spreadsheet, and I have different sections. So my syndicates are Irish Angels, Chicago Early, VITALIZE Angels, Angelist syndicates, and then a few other ones. I've also done some direct angel deals. That means I invest directly onto the cap table instead of via a group. And then I've done a number of funds. So those are the different sections. And then I'm going to read through the columns here and kind of explain what those are. I track the deal name, the date that I first made the investment, how much I committed, how much I've invested, the amount due. So this part's really important. Let's say you make a couple of commitments at one time, but you haven't invested the money yet. You want to keep track of what amount is due, whether it's direct deals or funds, so that you know what you've committed to before you make additional investments. So I've mentioned I've invested in 6 funds. Only a few of them have called all the capital. So I'm tracking how much is remaining that I know I need to have ready in my bank account if it's called at any given point in time. I track if they're still alive. I track if there will be a K1 this year. So for those of you who don't know what a K1 is, when you invest via a syndicate, you sometimes will get a K1. So this is a tax document that your preparer will need to put through your annual income taxes. And if you do a direct deal into a C Corp, you won't have one. If you do a direct deal into an LLC, you will have one. So it's really for LLCs and LPs. That's when you get a K1 for each of your investments. But you want to track that, because once you get a lot of deals, this can become kind of cumbersome at tax time. I track if there was a fee on the syndicate that I did. I track if there was a carry on the syndicate that I did. Once again, to me, underrepresented founders is something that it's really important, and I track that. I also track stage. So was it pre-seed, seed, series A? I track the post money at the time of investment and the post money valuation today. So when I think about the value today and I divide that by the value at the time I made the investment, the result of that is called the multiple on invested capital, or MOIC. That's basically the on paper return that I have on that investment right now. And then finally, I track the platform that I have that investment sitting on. The different ones are allocations, Carta, Party Round, AngelList, and you might have a few others. So it's just to help me keep everything kind of in one place. So then when I do all of this, I sum all of my direct deals, I sum all my funds, and then I have one more sum line where I do my directs plus funds, so that I can get a rolling total of how much I've invested, the value at today's time, and then what the total aggregate multiple on invested capital of that entire portfolio looks like. Okay, last section here, a few mistakes to just be aware of as you get started. So mistake number 1 is you don't really love the deal, but you invest anyway. So there's a lot of herd mentality in angel investing, especially when you're part of a group. So try to avoid that if you can, regardless of who else is investing. Does it fit your personal thesis? Is it the right stage, sector, price, etc.? Just get really used to checking in with your gut as you make these decisions. Most VCs say no to almost all the deals they see. So at VITALIZE, I think we say yes to like 0.25% of deals. Some angels say yes to, kind of 1% max. So don't expect that you're going to say yes to everything. Mind the cap. So cap table is effectively just a mathematical representation of ownership in the company. If too much of the ownership of the company is in the wrong hands at the early stage, this creates financing risk down the road. So a couple of checks that I look for at the pre-seed stage. So this is typically the first institutional round. Founders after that round should still own 80%. After the seed round, they should own about 60% of the business after that round. I also look to see, is there 5% of what I call dead equity sitting on that cap table that maybe a former founder or an advisor or somebody else that's not currently in the business still holds. And unfortunately, I will pass on those opportunities, because we want all of the equity in the company to be sitting with people who are adding value today. So it's really important to review the cap table anytime you make investments. Finally, if a founder's already done a significant pivot prior to their seed round, you really want to understand if it's a good investment opportunity, because what's likely happened is that investment dollars have come in to fund a business that has fundamentally changed big time. And once you sell a decent amount of the equity, and if you're not building on what was already done, you're effectively changing the business. Sometimes it does not make sense to go forward with that investment. Mistake 3, investing when the valuation is too high. So good rule of thumb is that founders should be selling 15 to 25% of the company at both pre-seed and seed. So I usually say 20%. It's often right down the middle. If you deviate from that too much, founder only wants to sell 5 or 10% of the business, I'll often pass unless there's a really good reason for it. Maybe they started and sold a business and had a huge exit and they're a phenomenal founder. Those are the only cases where it might make sense to have a really high valuation on an early stage deal. So you just want to avoid additional risk that happens when a founder either isn't raising enough or their valuation is too high at the early stage. Mistake 4, founders burning cash too quickly. So make sure that the founder understands what cash burn is. They're watching their runway. They don't have a ton of people on the team already. They've got reasonable salaries and they're raising money that will get them at least 18 months, if not 24 months of runway. So most of the time at pre-seed and seed, companies will not have achieved PMF or product market fit. And when founders haven't figured out what real product market fit is, they don't want to accelerate too quickly. So if your founder is talking about burning really fast, you might slow down on the investment. And finally, sometimes angels really want to get involved in the business. So I would suggest you not do that. We're typically hands off as angels unless the founder asks for specific help. And we know that the biggest places that angels can add value are interested customers, partners, and then candidates for open positions. So ideally, your founder is sending out updates once a month with asks. If you can help with any of those intros, please do, because as you add more value to the founders that you're backing, they remember that. And they will introduce you to other founders who are raising. So don't call with questions, don't expect special rights, and just generally stay out of the way. All right, Justin, we're up.
Gale. Okay, here we are. There we are. Perfect. So we have a few questions come in. We'll just start rolling with them because we have a bunch, and I'm sure more will continue to come in. So thank you everyone for popping those questions in. First one, I want to know more about investing through roll-up vehicles. Gale, can you maybe share more about if you've done investing through roll-up vehicles or other kind of forms of investing? Let's talk about that.
So a roll-up vehicle is a new structure that AngelList and a few other platforms have done. It's effectively a syndicate that the founder can pay for. They pay for the admin, and it lets them have people invest as little as $1,000 or $5,000, depending on what their minimum is. You typically don't pay a fee or carry, so it's just like investing directly into the business. But the founder is able to have a much easier time administering it. I think it's a great innovation within angel investing, and I've probably done 3 or 4 of them so far. So I'm a big fan.
Next question we have is for direct investing. So being on the cap table, should we assume a minimum check size of 25K? If we're investing below this amount, are the only options syndicates?
That's probably a pretty good rule of thumb. Most founders at pre-seed, sometimes into seed, will say they'll take strategic angels at 25K minimum. I've sometimes seen them come down to 5 or 10 at pre-seed, but it's rare. So 25K tends to be about what the minimum is. I think I've done of my 45, maybe 8 are directs, and my amount ranges from 5 to 25.
For in a given week, how much time are you dedicating to follow on for these investments, or just time spent on the investments themselves that you already have made? I know you say you made 45 or something already. How much time have you spent on these in a week?
Very minimal. I make introductions to founders here or there. I always do their updates. But for the most part, it's capital in, and the founders will reach out if they need things. So it's honestly not a big lift.
We had a question on you shared a version of this in the slides, and the spreadsheet for your investments. We'd be willing to share an actual spreadsheet, like a blank, clean spreadsheet with people. I don't know if that's an option, Gale.
I mean, I can create a dummy one, sure.
Perfect. I know people asked in the first session we had as well, so you might as well toss it in there. Any resources you're available for valuation, multiples, benchmarking to better evaluate the pricing of these deals, Gale?
Yeah. Multiples benchmarking doesn't really work at the early stage because the revenues just aren't there. And so I really like the 15 to 25% rule of thumb. Really, it's 20%. So I know if a founder is raising $1 million, it should be about a $5 million post-money valuation. If they're raising 2, it should be about a $10 million post-money valuation, give or take a few $1 million in either direction. Once you get into Series B, C, D, the valuation multiples start to make a little, or the revenue multiples start to make a little bit more sense. And then it really makes sense at exit. So when we model exit potential, everything that we do, or most of what we do, is software businesses, and our comps for exit revenue multiples tend to be somewhere between 5 and 8x ending revenues most of the time, unless it's a specific industry that's on fire and there's a lot of comps way above that. But at the exit, you can expect somewhere between that 5 and 8x return on the revenue the company can get at that time.
And anyone, if you have follow-up questions to the questions that Gale answers already, just feel free to add them to the chat. We'll also respond to those. Someone asked about kind of top resources for beginners, books, blogs, etc.
The first one that I would probably read is Brad Feld's Venture Deals, just to get acclimated to the VC jargon. What is a term sheet? What's a valuation? What's pre-money? What's post-money? What's a cap table? What are all these other rights like pro rata and anti-dilution and different things that I'm hearing? What do I need to actually know? And I think at one point there was a course that you could take on that. So I would suggest doing that. And then from a VC Twitter perspective, I think Elizabeth Yen's tweets or threads are really good. She walks through kind of what things are quite a bit. We do some truncated versions of that at VITALIZE, and trying to think, there's other really good books out there. Justin, do you have anything else to add to that?
Someone dropped a book, and I was going to say Secrets of Sand Hill Road is another good one as well, about more of investing. Jason Calacanis has a book on angel investing that's pretty in-depth about his experience. That's another one I'd say I would add. Those are some. There's also a series from Naval Ravikant, has a podcast on angel investing, but he has a series, it's like a 3-part series on angel investing, how to angel invest. That's another one. I think Paul Graham has one too. But yeah, those are some resources we've curated over time. So those are a few I would add, and we can always follow up and send some more. Someone's asking around how many meetings you typically have before you invest, and do you see full financials, customer lists, et cetera, to validate that what the founder is saying is truthful?
So at VITALIZE Angels and VITALIZE's fund, we ask for the following in due diligence: your historical financials, your projected financials. What we want to see your cap table. We want to see a list of references. So this includes customers, advisors, existing investors, key team members. We ask for anything else that the founder deems relevant. So sometimes it might be a product roadmap, there might be IP, it just depends on what the business is. So we're reviewing, sometimes we'll get a full customer list, but oftentimes we won't. Those are questions that we'll ask in a call versus trying to see all the contracts, for example. The financials and the cap table tend to be where we find the most we need to dig into. So once again, if there's cap table issues, we want to ask questions around that. Oh, a founder left, tell me more about that. Was it adversarial? Trying to get information on the real health and state of the founders and the business. And then the financials, let's say there's a bunch of accrued liabilities on the balance sheet. Well, that might not be a great investment if our cash going in is just going to go to pay off those liabilities. Or we might see in projected financials that in year 3, the expected revenues are only $60 million. And our approach is that we're looking for 100 million plus. So there's lots of different things that you can dig into from the materials that the founder gives you. I would trust your gut on, do you think that they're being truthful? And this is a hard one because we could introduce bias in the decisions that we're making. But I mean, I'm a big proponent on, if something doesn't sit right with you in terms of a feeling that you have about the deal, there's so many deals, just don't do that deal. And I've made the mistake before of, wow, everything sounds great. But then I did the deal and later it's like, wow, this founder was crazy. And I should have seen it. And I know I saw it, but I ignored it. So I think the biggest thing in all of this is to really trust yourself.
As far as direct investing again, so be on the cap table for people who can miss that part. How do you find join source rounds when you're direct investing on the cap table?
It's all about communities. So what founder communities do you have access to? Accelerator communities, angel investing communities. I'm on a number of deal share calls, Slack groups. If you start to ask people for deals, you'll start to get deals. And if you start to share deals out, you'll get deals. So it's that mentality of it's sales. I'm going to ask for it. I'm going to send it out. Like I'm constantly going to be hunting for it. So if you're in a position to do that yourself and source your own stuff for directs, great. And then conversely, if you're like, I don't really have time, interest, or access for that, that's where the angel groups and syndicates can become very useful because you can see a lot of deal flow that others are sourcing on your behalf.
On that note with syndicates, people are curious about, does joining a syndicate mean you're involved in every deal a syndicate is involved in, similar to buying into a fund, or do you get to pick and choose which deals?
Pick and choose. Yep.
And then someone's asking around, how much value can we bring to the table with a 5K capital investment? What kind of founders need a 5K investment?
What kind of founders need a 5K investment?
Yep.
Well, I mean, I'm of the mindset that, if a founder does a roll-up vehicle, they're looking for good people to help regardless of the amount of money that they are deploying. And so, I mean, almost all of my 45 deals have been 5K investments. So I think it's a great starter size for a lot of people. And I know we just did a deal at VITALIZE out of our fund. I initially did a 5K check via syndicate into this founder's pre-seed, and I made a bunch of intros for her seed stage VCs. One of them ended up leading it, and it was an oversubscribed round, but we got allocation into the seed because of all the intros that we made. So even though I was a small potato, a few intros really made a big impact. So that's kind of how I think about it.
Yeah, just to expand on that really quick, actually. So one person that comes to mind, Gale mentioned Party Round, and you've used the platform before. So Jordy Hayes is the founder of Party Round, and he mentioned early on, I think he had an investor, it might have just been $1,000 into his deal directly, but it's one of his friends who wanted to invest. Is maybe like $1,000, but he had brought like 50 or 100K in like revenue or another investment, whatever, from that $1,000. So when you talk about like check size to helpfulness ratio, perfect example where small checks can be very helpful. And even from talking to founders in our podcast and everything, they'll definitely take small checks. And by small, I mean 1,000, 5,000, 10,000, if that person is really helpful in some capacity. So they will do that. So there's some value you can do on customer intros, connections. If you have a big audience, you can help promote things, that sort of thing as well. We had a question around metrics. What metrics do you look for to determine how good the company is doing and whether to participate in pro rata rights?
So for those of you who don't know what pro rata rights are, once you make an investment and there's another round, if you are a major investor, as defined in the investment documents, you'll have what are called pro rata rights, which means that you can invest again to keep your same percentage ownership in the company. And essentially this question is getting at, when should you follow on and invest again if you have access into the same company? Because if you think about it, we see all these companies and we don't have a lot of information. We have to pick and choose which ones we want to write a first check into. But once we write that first check, we have special knowledge because we've seen how the company's performed over time. And having this insider information can be very valuable if the company is performing well. So for me, first with VITALIZE Angels, and for our fund, if the companies are accelerating their revenue, so they're growing, and the next round is led by an outside lead, so this is a new VC that comes to the table and prices the round, that tends to be where I prefer to follow on and write another check. If it is what's called an insider-led round, and somebody who's already on the cap table leads the next round, I may or may not, if they're still accelerating and that inside lead is just kind of taking advantage of the fact that they've got the inside information, I still might. If the company is not growing, I oftentimes will not invest again. And that goes back to portfolio theory. For me, I've made these 45 investments, not all of them are going to make it. And so I would rather hold my money and only put it in the ones where I really think they will make it, or I hold that money and I put it to a new first check, because first checks are always going to be priced lower. And that means that for the ones that go, I buy higher percentage in the earlier round. So the follow-on strategy, once again, has to be authentic to what you're looking to do. you can range from you follow on in every single deal you do to you follow on in nothing that you do. I fall somewhere in the middle, but it's really figuring out what's important to you as you create your strategy.
Gale, you said you do a mix. Just following up on that, you do a mix of follow on versus not. Take me through that in terms of how you're thinking about that.
Okay, so that was the VITALIZE answer. My personal answer is I hardly ever follow on, personally, because I'm looking for, ideally 100x plus return potentials personally. So I would prefer to save my cash and put it into another first check. There are some exceptions that I've made to that rule earlier on, and this shows you that you can change your strategy over time. Earlier on, I would follow on in most of them. So my 5 or 6 follow-ons, almost all of them happened with deals I first did in 2017. I'm sitting on one today where I wrote a first check in January of this year, and the company is doing really well, but I haven't written a follow-on check in a long time, and I'm trying to figure out if I want to do that or not. It probably still is a good investment, but is it 100x? I don't know. So I lean personally towards not, but I think you can be very successful by having a regimented approach to how you're going to pick and choose, and not just letting emotion dictate as the opportunities come up.
Go on a similar note with that pro rata. How do you ensure you get pro rata rights if you're investing in seed stage, or even I can ask, I guess, pre-seed? If you're investing through a syndicate, is it just making sure pro rata language is in the deal terms? Take us through more of that.
Yeah, you want to ask the syndicate lead. So when we run syndicates, we try to negotiate that on behalf of all of our smaller investors. And it typically is just defined in the investment documents. So if you're raising $1 million, a major investor might be 200K plus check. So if your syndicate's doing 250, the syndicate has pro rata rights. And now it's up to the manager and how your operating agreement for the syndicate is written in terms of if you have pro rata rights. So the way I've always done it before is the individual investors who've put money into that syndicate, they get first crack at any sort of next round opportunity. And then once they get their allocations filled, if there's more, then we can go to a broader community and bring new people into the deal. I'm guessing that that's probably what most syndicate leads do when they have it.
Are you seeing the impacts of public and late stage markdowns trickling down to pre-seed and seed yet?
Yes and no. Some founders get it. Like I talked to a founder today who's raising 800K on an 8 million post, which I still think is a little rich. But he was very much like, I'm willing to negotiate. I get that the market's not great and we've got 600 of the 800, but we want great partners. And if it needs to be different, let's talk about it. So I'm hearing more of that, where founders are open to negotiating, where before maybe they wouldn't have been. So it's a little bit of both at the pre-seed and seed stage. I think by the end of the year, it'll come down even a little bit more.
All right, no one asked this, but I'm going to ask it because I'm curious now. Just take us through, because you've been angel investing for a while. I also led different angel groups since 2012. Just take us through those valuations. Like, what do you even mean in terms of what's high, what's low? For people who don't have any context around it, maybe they're starting now, like they see a deal, it's like, this is a 12 million post, this is a 20 million post. Like, people don't have the context. Just take us through maybe what you've seen or what factors kind of dictate what would be a higher valuation, those types of things too.
So in 2018, if I would have done a deal in a seed round at a 20 million post, so after the investment is made, the company's worth $20 million. The annual recurring revenue would have been about 1.5 million. Today, companies are trying to get like 25 million posts off of 1 million in revenue. And so you can see that there's some inflation in terms of valuations, even over the last 4 years. That's probably going to come back down to 2018, 2019 levels, which is good because in the last few years, valuations have gotten way too high. And what we're going to see in the market is that founders are not going to be able to raise what are called up rounds. So that means the next round of capital, typically the founder would want it to appreciate in value. Well, today, because they took either too little money or at a too high a valuation or both, those founders are in a spot where they didn't hit the milestones that would be commensurate typically with the terms that they got. And that means they have to make a hard decision. Do they do what's called a down round and dilute everybody and kind of bring things back to reality based on their actual metrics internally. And this is where a ton of friction happens because your existing investors hate that, your founders hate that. And that's why it's really important for founders and for early angels like us to make sure that the companies are priced right off the bat, to not introduce that additional financing risk. So my rules of thumb at pre-seed, typically the founders are raising, $1 to $2 million, and it's that 20%. So if it's one, be a 5 post. If it's 2 million raised, it's a 10 post. So that's most of what you're going to see in pre-seed. At seed stage, most of the time, founders are raising $2 to $4 million. And so your valuation is 10 post up to 20 post. And that's going to be the majority of seed stage deals. Now, there's stuff on either end of the spectrum, and that can be determined by geography or by founders having former exits or other things about the business that make it a really great deal. Like I've seen sometimes where revenue is like off the charts. And if you can go from 0 to 3 million in 1 year, like you can charge a higher valuation than most founders who are in your stage.
We didn't have any other questions yet in the chat. I have all the questions from last time, which we will be posting as YouTube videos / content. And then we also have recordings from that time as well. But if people have other questions now, feel free to ask them. Otherwise, oh, Gilberto coming through hot with the big question. Gale, can you see that in the chat?
I can.
Perfect.
Right.
You want to read it out loud?
Pro rata is super important as you build a portfolio because it gives you the ability to keep the same amount that you entered. You need to worry not just about multiples on investment, but also dilution as an early stage investor. Even if you don't have the cash to do follow-ons, if it's a hot company, you can raise as an SPV and earn carry. I simply don't invest without pro rata at the pre-seed and seed. If the founders aren't willing to give it just pass, there's always another deal down the road. So this is a great example of Gilberto's approach, slightly different than mine. Great. I'm the type of investor that appreciates multiple perspectives on this stuff. There's not one right way to do any of this. So thank you for sharing that, Gilberto.
Another question we had was around, does a good product with the right audience always work?
I mean, unless your founder is, there's a challenge there. So the things that I look for in an investment, it's a big and growing market. So 3 billion plus market size, early indications of product market fit. So even if you don't have revenues, you've talked to a bunch of customers and you're able to explain to the investor why this is a pain point and why we need a solution and why your solution is the right one to meet that need. The thing that we spend the most time on in diligence is really the founder, because markets can change, solutions can change, but founders will not change. And is there founder market fit? Is the founder passionate? Has the founder gone out and gathered a whole bunch of information? Do they have specificity in their answers? Are they coachable? Are they able to execute quickly and ship product without it having to be perfect? Like these are all things that we dive into in the early stage due diligence process. So most of the time, good product, right market will work if you've got the right founder to execute.
All right, we're going to dive deeper on the founder part of it. Someone had asked around gut checks on founders, what to keep an eye out for. Like, how do you even gauge that, I guess, Gale?
This is personal. Like today I talked to a founder that a VC who I love is leading the round, and I did not like that founder. And it was just kind of rubbed me the wrong way. And so, but I love this other investor. I've worked with him before. I think he's a great investor. I think the deal will probably be successful, but at the end of the day, I passed on the phone because I'm like, I know that this founder's approach is going to drive me crazy. So just once again, pay attention to your gut. And that's why you have to sit in the room and hear a bunch of pitches. The groups and the syndicates are really helpful for that, to get volume under your belt quickly. Or you invest in the fund, and then you're going to get quarterly reporting from your GP, the general partner that manages that fund. And you'll also be invited to an annual meeting where you can hear from founders and hear from the investor, and you can start to understand how that portfolio is performing. It's those reps that are required to really start to build your own thesis and thinking around the founders that you want to back.
Yeah, which goes back to the point of what you mentioned kind of earlier. It's like you get to choose as an investor who you invest in. So that is ultimately kind of up to you in terms of that. And even on that, with you mentioned some of the things with evaluating founders and just going a little bit deeper on that, ability to execute, or are they coachable? Are there things that you look at or ask specifically to kind of get down to it? Because I know we hear some of these answers, we're like, we've heard them before, but also like, if you're new to this, like, what does that mean necessarily? Anything you can do to kind of expand or give examples of a founder maybe that is coachable or proven they could execute beforehand?
Yeah. I get to the coachability question just by listening to their answers. So I talked to a different founder today who I think is very coachable, the one raising the 800K. And it's because he was talking about the VC who introduced me to the deal. And he's like, yes, this VC, he told us all these things. I think that's right. Like, that's what I'm doing. So you can hear how the founder's thinking in a lot of their answers, even though I didn't specifically ask something to try to get at coachability. I try to get it an ability to execute, an ability to problem solve and to think critically, the ability to sell, the ability to think about process, just by asking questions like, walk me through your sales process. Is this founder-led sales? How are you going to build out a sales team? How are you thinking about your data science strategy? Is one that I pass on a lot of deals because of. Like, if a founder doesn't have much behind a data science strategy, but they're telling me that that's part of their future value proposition, like, well, okay, I just don't believe that you've thought through this enough to even be raising venture capital right now. But that's my approach. Like, there are some VCs that are very product focused VCs. They want product founders. I have a few successful product founders in my portfolio, but I mostly have successful operations founders in my portfolio. And that matches what I'm good at, because like, I'm totally a process person, and I gravitate towards that, and I can assess that way better than I can assess a product focused founder's ability, whether it's to ship product or to lead a business, because product focused founders have to do both.
I know we touched on this a little bit, but can you just expand on different angel groups or syndicates and options there? Because I know people are going to be curious about that, like what their fee structure is, how to join them, maybe what you'll see from them, anything you know of from other groups as well.
There's something called the Angel Capital Association that will have a list of hundreds of angel groups that you can join. The fees range from free to $5,000 to $10,000 annually to have access to those organizations. So if you're new to this, obviously I wouldn't suggest spending thousands of dollars right out of the gate unless you really love a program. So the two programs I like to suggest, if you're ready to go to that level, are On Deck and Hustle Fund's Angel Squad are great programs that are about in the $5,000 range. And then if you're looking for something less expensive, you can try us out. We're $600 a year. Angels, Gaingels, allows people to join for free, I believe. And then Angellist syndicates often are free. So you can go on there and try to find GPs that you like their portfolios and see if you can join their syndicate to see their deal flow.
And then those are the fees. But what about carry for people curious about that, and explain what the carry side of it is?
Yeah, so carry is the incentive structure for a VC or a general partner that's running a fund, or a person that's leading an angel syndicate. Traditionally in venture capital, carry equals 20%. So if you as a syndicate invest $1 million, and let's say at some point that $1 million turns into $10 million, the $1 million goes back and as principal paid in to the investors, and then that $9 million of profit is typically split 20% to the syndicate lead, and the other 80% based on pro rata of the investors within that syndicate. And carry for syndicates can range from 5 to 25 or 30%. I think most are probably 15 to 20. And for most VC funds, if you go that route, small funds are going to have a 2.5% fee, and they'll have a 20% carry typically.
We have 2 or 3 minutes left here. Does anyone have any other questions? I could ask Gale questions all day, but anyone else have any other questions? We just have some thank yous. Thank you to everyone for attending. Let's see. I think that we'll give a second longer. Last second throw into you for a question. You got 2 minutes.
I'll wrap up with some final thoughts. It's just, if this is interesting to you, don't think you have to be perfect at it. I am still very ill-equipped in many of the things that I do daily for VC and Angel. I don't know a lot of things, but I also think I'm a very good investor, and it's taken me 10 years to get here. So I had to start from somewhere, and it seems scary, but if you're interested in this, that's why the community can be really helpful, to join a number of syndicates and groups and start small, writing checks of somewhere between 1 and 5,000, depending on what you're looking to deploy. You don't have to come out of the gates writing those 25 or 100K checks in order to get access to this asset class, but you will learn as much by writing small checks as you will by writing large checks, which is the cool thing about it.
Absolutely. Someone did ask when we're going to have more sessions. Sorry, I'm greedy. You're not greedy. You just want to learn more. I love it. We are probably going to do another one maybe in a month or so. We did 2 this month, but if there's interest, I mean, we're definitely open to do more of these. I think it's valuable for people.
We'll send the recording out too.
Yeah, the recording would be out in a week or 2 once we clean that up as well, our editor. But thank you everyone for attending. Really appreciate it.
Thanks, Justin.